नमस्कार दोस्तों, मैं हूं गणेश शिंदे। दोस्तों, मैं आपको सिखाना चाहता हूं शेयर मार्केट क्या है, सही है या गलत है। मैं गणेश शिंदे ऑनलाइन ट्रेडिंग एकेडमी फाउंडर कोच में।
Have you ever wondered why traditional support and resistance levels seem to fail you right when you need them the most? You know the feeling. You meticulously draw your lines, the price hits them, but instead of that beautiful, clean bounce, you get this chaotic, erratic reaction. Or worse, a false breakout that just totally stops you out. Look, if you feel like you're constantly falling into these invisible traps set for retail traders, trust me, you are definitely not alone. So, welcome to this explainer. Today, we're diving into Charting the Smart Money, a guide to supply and demand zones. Our goal here is actually really straightforward, but it's a total game changer. We're going to help you stop trading that noisy, unpredictable retail chart pattern stuff and start tracking the actual buying and selling power of massive financial institutions. Okay, let's dive right into this. We've got a quick 4-step roadmap for today. First, we'll look at the institutional footprint. Second, the anatomy of a zone. Third, drawing proximal and distal lines. And finally, identifying fresh zones. All right, kicking things off with part 1, the institutional footprint, beyond support and resistance. So we really need to rethink how we look at market structure here. See, conventional retail support and resistance, it mostly just reacts to turning points. These levels get tested multiple times, and honestly, they're highly prone to traps. But institutional supply and demand zones are a whole different ballgame. They're found at the true origin of strong momentum. We're talking about massive imbalances between buyers and sellers, the exact literal places where huge trend movements are born. And the thing is, these visual footprints act like a massive, endless buffet for demand, where buyers step in with serious force. Or, on the flip side, an end-of-season liquidation sale for supply, just crushing prices down. The big players simply can't hide their massive volume. Huge blocks of institutional orders are just sitting there waiting at these origins. Our job? Just gotta spot them. Moving on to part 2, anatomy of a zone, deconstructing the imbalance. Now, before we can even think about drawing these zones, we absolutely have to deconstruct their basic building blocks. Every highly effective zone consists of 3 critical components. First up is the leg-in, which is basically just the initial price action leading into the area. Second is the base. Now, this is a period of tight consolidation where supply and demand kind of balance out for a second. More importantly, it's where the smart money is quietly accumulating their large orders. And third, the leg out. This is that explosive institutional price move that screams massive imbalance. And this brilliantly illustrates the physical difference on a chart. Check out the explosive leg candle. The expanded range candle with its massive body is showing real aggressive intent. Then compare that to the base candle right next to it, a narrow range candle. It's balanced, it's narrow, it's quiet. It's literally the calm right before the storm. So let's walk through how they fit together in a real setup. Looking at this demand zone, notice the exact sequence happening here. You get a drop for our leg in, right? Then a tight consolidation forming the base, and boom, a massive explosive rally for the leg out. Spotting this specific drop base rally sequence is the absolute key to identifying a high probability setup. All right, let's get into the mechanics. Section 3, drawing proximal and distal lines, the blueprint. To make sure we're not just guessing where the smart money is hiding, there's a strict sequence you gotta follow. First, mark the current market price. Second, scan left, then up or down, looking for a visibly explosive price move. Third, identify that leg in, base, and leg out structure we just talked about. And finally, plot your horizontal, proximal, and distal lines. Let's make sure we clearly define these 2 crucial lines because they are your entire framework. The proximal line is the boundary of your zone that sits nearest to the current price. When price eventually retraces, this acts as your entry trigger. Now, the distal line is the boundary farthest from the current price, and this line is incredibly important. It represents the exact point where your setup is invalidated. It dictates exactly where your stop loss should be safely placed. Now, what's really interesting here is how this visualizes the safe entry buffers around the current market price. Look above, the supply zone awaits, with the proximal line acting like a ceiling you can short against. Down below, the demand zone's proximal line acts as a floor to buy from. It neatly puts all that chaotic price action into a tightly defined, manageable box. When you're actually outlining these base candles, traders typically use one of 2 acceptable methods. You've got the body to wick method, which places the proximal line on the body of the base candle and the distal line on the extreme outer wick. Alternatively, there's the wick to wick method, where you place both lines on the absolute extreme wicks of the base. Whichever you choose, just remember, precision right here is what filters out the noise and clearly defines your exact risk. Which brings us to part 4, identifying fresh zones, the final filter. So what exactly is freshness? Well, a zone is considered fresh if the price has completely stayed away from it since it was first created. And this matters immensely. It means all those massive institutional pending orders remain sitting there entirely unfilled. Think of it this way. Every single time the price revisits a zone, that zone acts like a sponge soaking up water. The previously unfilled orders just get absorbed, and the level weakens with every single touch. Let's see how this builds visually by comparing the 2. You can clearly see the difference a test makes here. On one hand, you have a pristine, fresh zone. Price exploded upward and hasn't looked back. The institutional trap is perfectly set. But then look at the not fresh zone. The price has already dipped back into that box, soaked up the lingering orders, and severely depleted the smart money backing. And then there's one scenario you absolutely want to actively avoid, the violated zone. Here, the price hasn't just tested the level. It's completely smashed right through the distal line. The imbalance has been totally resolved. All that institutional support, it's gone. Trying to catch a bounce here is basically just trading a ghost level. So let's quickly summarize our strict rules for a highly effective zone setup. You want to see moderate volatility in the base, meaning narrow candles, no wild wicks. You want a timely exit so the market isn't just hanging around in that base for too long. You need a strong explosive force leaving the zone. And most importantly, absolute freshness. So the crucial point is combining all these factors gives you the absolute highest possible probability of trading right alongside the big institutions. Which leaves us with one final question for you. Are your charts showing you the real story, or are you just trading the noise? Now that you know what to look for, I highly encourage you to open up your trading platforms today, scan those charts, and see if you can spot these institutional footprints for yourself. Thanks for joining me for this explainer, and happy